Derek and Jake, thanks for joining me. This is Brian with Boer Insurance Group here. Today's webcast is to explain what's happening in the auto and home insurance world in the simplest terms possible, even terms that I can understand, keeping in mind that my reading comprehension has never progressed past about a fourth grade level. Derek, Jake, thanks for coming on with me to help explain what's happening, right? We're halfway through 2023. Most people are aware that insurance costs nationwide, almost all products wide, and even locally here in West Michigan are on the rise. What's happening?
That's a very good question. Well, there have been pretty drastic premium increases, not only in Michigan, but across the country, like you mentioned, because we've seen a lot of inflationary pressure across the various components of an auto insurance policy and a homeowner's insurance policy. Keep in mind that that auto insurance policy, it's going to pay the current price of repairing your vehicle. That means current pricing for the body parts, for the labor, for your rental car, if you have rental car coverage. And if it's a homeowner's claim, it's going to pay the labor cost for a carpenter to come in and do the floor trim, a roofer to come in and put new asphalt shingles down if a windstorm ripped your roof off. The cost of those materials have obviously risen quite drastically over the last few years, and the labor has as well. So we're seeing those pressures flow through the insurance world because at the end of the day, an insurance policy is just a promise from the insurance company to pay the expenses that are associated with something that goes wrong from an auto or a homeowner's insurance standpoint.
So why are we looking at this expected results page here, right? This looks healthy to me. It says premiums collected 12,000, claim payments made 10,000 with a profit of almost $2,000. That looks healthy. What's the problem here?
Well, insurance companies have, decades and sometimes hundreds of years of claims experience, right? So they know that there's going to be a year when that hurricane comes through Florida or those wildfires break out in California, and there's going to be a bad year mixed in there sometimes. But historically, they know what they need to price each product at, whether it's the auto insurance or the homeowner's insurance or a variety of other types of insurance products as well, in order for them to bring in enough money to pay out the claims that are going to be happening. So the expectation is that the insurance company is going to take in more than they're going to pay out in claim expenses. And the difference is, of course, going to be that insurance company's profit. Almost every insurance company is indeed a for-profit company. They have shareholders, they have stakeholders, they have to answer to a board of directors, and at the end of the day, they need to come up with some sort of profit to validate their existence.
Sure. So what are these actual results? I mean, how much does this different, right? I see here on this expected results of these 14 people, I see 2 of them unfortunately had to file a claim. It looks like one of them was a $1,900 claim. Maybe that was a vehicle hit while parked, or maybe a little bit of damage to the gutters when a tree came down. And then I see an $8,400 claim, maybe hitting a deer, or maybe having some hail damage to a roof. Here I see in the actual results that those 2 claims certainly did happen, and it looks like the insurance company ended up paying out more on each claim than they had expected. And I also see a 3rd claim falling into the mix here at $3,600. So tell me what's happening here with these actual results, Jake.
Yeah, so as Derek mentioned, tons of, inflationary pressure on the industry. People hate hearing about it at this point, but some of the aftershocks of COVID, you could say, some of the supply chain limitations and issues that we ran into there drove up cost of used cars, supplies cost, labor costs, all the things that go into an auto or homeowner's insurance claim payment. So we have that paired with an additional claim that wasn't foreseen. So we had 2 different factors going here. First being increased costs paid out for each individual claim, and then second, of course, more claims than anticipated. So not a great combination.
Sure. And obviously this is talking on a very small scale of what's actually occurring among, millions of people buying insurance, right? We're looking at a very small segment here for example purposes. But what about me? I didn't file a claim last year. My car wasn't hit while parked. I didn't have a hailstorm roll through my neighborhood. So I see premiums here for going forward, the premium impact looks like every insurance policy takes a bit of a bump from a premium standpoint. And here going forward, we're looking at premiums collected of about 14,000 instead of 12,000 that were collected here. Why does that happen? I mean, what's the result to me as an individual that's just one small piece of this entire insurance puzzle?
Well, Brian, go back to that very first slide. Let's look at that first claim, the $1,900 claim, right? So maybe you were someone that had a claim, maybe you were someone that didn't, but that $1,900 claim is actually, next slide, $2,700, right? So the insurance company is not necessarily saying that you are more likely to have a claim next year, but they are saying that even if that likelihood stays exactly the same, if it does occur, the insurance company is going to be paying out more. So there's one factor of it. It's the likelihood of a claim might be the same, but if it does occur, the insurance payment is going to be higher. And then there's a second component of that as well. This third claim that the insurance company did not expect to occur. And we're like everybody else. We don't ever think a claim is going to happen to us, but realistically, given the weather patterns over the last 5 years, given the driving that we've seen, whether you're here in West Michigan or in Metro Detroit, it's no surprise that claim frequency is up over the past few years. And of course, even if the claim expenses weren't increasing the way that they've been, when the frequency goes up, there's going to be rate increases as well, because the insurance company, again, needs to bring in enough money to pay out all those claims and then hopefully have at least a little bit to reserve for profit at the end of the day.
Interesting. Now, historically, insurance premiums have roughly paced inflation on an annual basis, right? So this year, when you're seeing, industry-wide an 18 or 20 or 22% bump just in the base premiums, is this a one-time thing, or is this something that I should be prepared to face every year going forward?
That's a really good question. It's going to depend on so many factors. It's very, very hard to predict. Brian, as you know, the state of Michigan has to approve every insurance company's rate adjustments every year, whether they want to make their rates go up or go down. In either event, the state of Michigan has to approve what the insurance company is going to do. So I've been asked by a lot of clients, why are there headlines about some insurance companies pulling out of different states? We see that in Florida all the time, and we've started to see it in California as well. And what impact does that potentially have to people that are buying insurance in that state? It's not a good thing. You're obviously having less competition in that state, and naturally that leads to higher premiums because the insurance companies that remain are absorbing all of that excess insurance risk, and they raise rates accordingly. So it's really hard to determine what's going to happen in 2024, 2025, 2026, but we would like to think that if the cost of products and services return to somewhat of a normal level, you would think that the insurance costs would normalize as well. If they continue to stay high and or even increase further, well, then we're going to see not only the cost of insurance rise because of the claim payments increasing, but we have to sit there and hope that the frequency of claims is not increasing as well. When you have both of those combined, like we've had over the last year and a half, you're seeing rates hit, 18, 20, 22, sometimes 35% across almost the entire insurance industry because both of those factors are, rearing their ugly heads together.
Gotcha. Okay. So eventually the market should normalize to the point where insurance premiums collected are at least equal to the claim payments going out the door. That's step one, where insurance companies are viable. They have a chance at potentially turning a small profit, at which point things have somewhat regulated and just need to be maintained going forward in terms of where those claim payments are that are going out the door. Number one, how frequently are claims being filed? And number two, what's being paid on that typical claim as it occurs. True?
True.
Understood. Awesome. Well, Derek, Jake, challenging conversation, not something that anybody ever wants to see, just like any other product or service that we all pay for out of our budget. No one wants to pay anything more than what we've ever been accustomed to, but I feel like it's important to understand what's occurring behind the scenes, why it's occurring, just so that we can be aware of what's happening in the industry and what's rising, what's causing this change in the insurance market, what's leading these headlines that you see in the news. So I appreciate you jumping on here to share some of your advice and some of the input from behind the scenes.